Example that we have, we're going to do a reconciliation of Bob's company. We get information on his cash account that says that the balance at March 1st was $20,000. The balance at the end of March was 21,000. He got cash deposited of 50,000 and checks that he wrote of 49,000. The bank statement shows a balance of 20,000 on March 31st, and it gives the following information. Let me write this. Um, they collected 1,500 of the notes plus interest of $20 for a total of 1,520. They earned interest on the checking account, $40. There was a not sufficient fund check from John Jones, $500. Oh no. And then there was rent that you had to pay for a safety deposit, $60. At March 31st, deposit in transit were 4,000 and the outstanding checks were 2,000. So what we have to do here is prepare a bank reconciliation for Bob Company at March 31st. And so what does the information tell us to start off with? We have the balance per the bank statement, $20,000. It tells you uh, March 1st. It was $20,000. You have a deposits in transit of $4,000. You know you need to add that because the bank doesn't know that you have those on the way. They don't know that you've written checks of 2,000, so you're gonna have to take the outstanding checks away from your balance to get you a adjusted cash balance of $22,000. Now your books and records say that you have 21,000. But the bank sent you a memo said, hey, they collected notes receivable of 1,520. Remember that? The 1,500 plus the $20. They also told you that you earned interest on your checking account of $40. It's a little bit, but you need to account for it. That total is 1,560. So that 1,560 plus your 21,000 is 22,560. Oh, the bank also told you this. John Jones, he wrote you some checks that didn't go through. He didn't have money. So you need to remove that from your balance, that $500. And you also need to remove the safety deposit fee that they charge you of $60. So your new adjusted cash balance per books is 22,000. Those reconcile, 22,000 reconcile. Part B asks you to prepare the adjustment entries, assuming the NSF check was from a customer on account, and two, no interest had been accrued on the note. So for the first one, if if you had if you had cash, excuse me, if you had cash of 1520 that you were expecting and the bank told you received it, you have to debit your cash. The notes receivable is no longer outstanding, so you need to credit your notes receivable and credit your interest receivable to record that note receivable that was received. You earned that little $40 of interest, and so you got cash that you need to, excuse me, you need to debit your cash because you have the revenue now. You need to credit the interest revenue. That's to record the interest earned. Again, John Jones, he wrote the check, and you previously had credit to the accounts receivable because you didn't think he owed it anymore, but it didn't go through. So you need to account for that he still owes you the money. And you thought you had the cash in the bank, but the bank said no, didn't go through. So you had to reduce your cash, and you reduce cash by crediting it. Then you have your bank expense. Um, so cash is decreased, and you have to recognize a debit in your income statement for bank charge expense.